Hi, welcome back. Well, good going for the markets. The Nifty is above the 16,000 mark, at least maintaining its head above water. And it's time for our special segment now, Quarter Se Quarter Tak. Today, we place the spotlight on the FMCG sector and what's expected from the companies. Manglam, take it away.
Well, I'll tell you one thing about the FMCG sector. After 2 years of underperformance, it's actually outperformed this month, the best performing sector. So it calls for a bit of a walk to the big wall, so to say. So to talk about the FMCG sector in the first quarter, let's tell you that the margins will decline this time around. It may weaken further versus what we saw in the fourth quarter as the full impact of the Russia-Ukraine crisis will play out in the first quarter itself. However, that's not an unknown fact. In fact, from the peak, the commodity prices have cooled off as well. So, we will see some bit of benefit coming in. The big question is, are the margins going to be at the bottom in the first quarter itself? And from here on, it will only increase or not. In terms of a top line, year-on-year, comparison will be distorted because for most companies, the first quarter FY21 was hit by pandemic. And then the first quarter FY22, which is the comparable quarter, saw a big recovery of a low base, but still was impacted on account of the second wave of COVID. Therefore, to look at the numbers, it will be important to also watch out for what the management commentary is, because that will be more important than just the reported numbers on both demand as well as, more importantly, on the margins itself. But no questions when it comes to summer-focused businesses like Varun Beverages, which is the Pepsi bottler, and HUL's ice cream business, or something like Hatsun Agro as well. They will do extremely well because it will be the first normal quarter after 2 years of weakness in summer. What we know so far from the updates that we have, Titan's first quarter jewelry sales have grown up by almost 207%. GCPL has reported high single-digit sales growth, but most of that has been price-led, and despite that, the margins will actually be lower year-on-year. Marico's India business volumes declined in mid-single digits, but operating margins will expand because Marico and Tata Consumer are two companies which are, facing commodity deflation as against other companies which are facing commodity inflation. And in a first, Dabur too has reported mid-single digit volume growth. The first is not their mid-single digit volume growth, but for the first is the fact that they've given us a quarterly update. But for them, margins will dip by about 200 basis points as well. In terms of volume growth expectations for most companies, it will be ITC as well as the paint sector which will take the cake. ITC cigarette volumes likely to grow between 25 to 28%. We've seen ITC do extremely well in trade as well. Asian Paints on a low base, or rather on a high base, is expected to grow over 25%, and mid-single digit volume growth seen for names like HUL, etc. as well. But like I said, the base would be distorting all the numbers. In terms of stock price performance, we've seen all these stocks do well. The FMCG index has been the best performing index in this month itself. The Nifty is up 9%, whereas individual stocks, something like an HUL, is up around 12% as well. The key triggers for the FMCG space now, the first one is this global coordination towards taming inflation and the decline that we've seen in commodity prices from the peak as well. And in that, the companies have already taken price hikes, cut their costs to support margins. So that may mean that further margin improvement may come by. On the demand side, second half of this year will see some bit of demand uptick because so far the monsoons have been normal, slightly better than normal in the month of July so far. So that would mean good news for rural consumption as well. The other couple of factors that everyone was worried about was, the competitive intensity coming from new age D2C players. That is being cooling off as the valuations in that business have cooled off as well, and the funding. And the 2-year underperformance of the FMCG sector has sobered the valuations from their peak. So all these things augur well for the sector.
Okay, so the stocks have been doing well in today's trading session in last couple of weeks as well. So it's a good time to take the discussion forward with Abneesh Roy of Edelweiss Securities. Abneesh, good morning. Thanks a lot for joining us. Well, you heard Manglam, of course, we all know, and something we've been talking about, the input cost pressures that will hurt margins in Q1. But now we've been seeing that commodity prices have cooled off. Considering all this, do you think the margin weakness that is bottomed out, and from here on we'll see margins improving for the FMCG companies?
Yes, thanks. Yes, I do expect Q1 gross margins and EBITDA margins for most companies to bottom out. See, FMCG companies work with a inventory and forward contract lag of around 2 to 3 months. So in Q2, we do expect September month to be remarkably better than the first 4 months, 5 months of the year. So yes, margins will bottom out. Even in Q1, most of the companies have taken further price hike. So definitely that will also help. I do expect Street to upgrade earnings in the case of biscuits, detergent, soap companies from a gross margin perspective and possibly EBITDA margins also in the second half. And FY24 definitely we see very good in terms of EPS growth also, volume growth also. Of course, we need to see the monsoon because UP, Bihar and Jharkhand, there is a big deficit currently. We also need to monitor the INR depreciation because a lot of these raw materials are also imported. Plus FI selling continues currently. So these are the three minor overhangs. But in terms of macro, clearly we have seen a reversal of fortunes.
You have some numbers, Abneesh, in terms of the kind of upgrades that you expect in the second half coming, because you put out a note yesterday and you said that you expect a lot of the FMCG companies, and I'll ask you to name those stocks as well, are likely to hit lifetime highs over the next couple of months.
Yeah, so already if you see around 4 months back, there was so much pessimism on the sector, but we have seen, for example, HUL, the bellwether of the sector, move up from 1900 to 2500. So I do see that in the next 2 quarters, a lot of stocks like Hindustan Unilever, Nestle, Asian Paints, Pidilite, Britannia, I expect them to hit all-time high. See, there is a very good case study which is available right in front of us, Tata Consumer and Marico. In both companies, we have seen a very good margin improvement in spite of the current headwinds we have seen in the Q1 and the last financial year. So coming to upgrade in second half, if current scenario continues, because as I said, rupee depreciation, crude oil is extremely volatile. Those are caveats. But I do expect in second half, for the second half, I think 5 to 6% upgrade is possible. And FY24 clearly with rural volume growth also reviving, plus full year benefit of the raw material, I do expect further 5 to 7% upgrade for FY24 if the current scenario continues.
The next and most interesting stock that we've been talking about and that has been doing really well is ITC, Abneesh. We are expecting good volume growth in Q1 for the company. We've seen the stock move as well. But is that it? Do you expect it to, plateau from here on, or there are more triggers for this particular stock?
Yeah, in fact, we have ITC as 30% weightage in our model portfolio. So I do expect definitely the stock to do well from here on also. If you see first half, a lot of the businesses have a very favorable comparables. Q1 especially, agri-business, cigarette business, hotel business will see very good growth. Even in FMCG, stationery, which is a high margin business for them, saw very tough times last 2 years. So yes, I do expect ITC stock also to do well. Of course, on February 1st, the next event we need to watch out. But we recently upgraded the target price of ITC to around 340, 345. So we do expect ITC to continue to do well in the next 2 quarters.
If we look at a couple of these discretionary names, be it the paint space or jewelry retail as well, something like Titan, where do you see relative strength and better valuations, and as a result of which more outperformance coming in? Would you back someone like Titan, or would you look at Asian Paints, which is about 18% of its highs, or would you look at Berger Paints, which is about 33% of its highs? How would you position yourself in this space?
Mangalam, that's a very good question. Between those few names, I will prefer Asian Paints. See, in Titan, we have seen some of the regulatory overhang which has come. Recently, we saw that. And rupee continues to hit new lows every week currently. So that, I think, slight overhang continues to remain. If you remember, around 7-8 years back, we did see the previous government, not this government, had taken multiple steps which had led to derating in the jewelry stocks. Yes, Q1 numbers of Titan were extremely good, better than expectation, and that's why the stock has come back. But when I compare a jewelry stock to a paint stock, clearly I'll have a preference for Asian Paints. We have seen that the diversification to non-paints is really helping them. Even in Q1 on a slightly soft base, we expect very strong growth of around 38%. And even in terms of price hike, they have taken further 2 rounds of price hike. See, Grasim entry is still 5-6 quarters down the line. So crude correction clearly will give a lot of ability to see margin expansion. So I'll prefer a Asian Paints over a Berger because there will be more concern of Grasim on a Berger, Akzo and Kansai. So clear preference for Asian Paints because of the diversification and because it is a very strong market leader. It is expanding distribution further. So that's a very proactive step against Grasim.
And final question, Abneesh, then, these are companies that always show some sort of potential, and which is why they, but they never match that, which is why they trade at the multiples that they do. I'm talking about Emami, I'm talking about Bajaj Consumer, and I am talking about Jyoti Labs. In the second rung of the FMCG stock, so to say, do you think there is anyone which shows any sort of promise?
Absolutely. Emami stands out because one, they will have almost 50-55% of their India portfolio coming from rural. The second half, we will see rural recovery because of the monsoon, because of the government steps, because of the general crop prices also. Secondly, Emami has been quite active in terms of the M&A. So the recent acquisition of Dermicool will help them really stand out in terms of growth. If you see this quarter also, their base business will see much slower growth. But because of the Dermicool acquisition, they'll end up at a 12% revenue growth, which is a good growth in that kind of a company. So yes, from a raw material perspective, also packaging cost will see the benefit because of crude oil. So in the mid caps, we'll prefer Emami over the other names which you mentioned.
All right, Abneesh, thanks a lot for joining us and taking us through the expectations from Q1 as far as FMCG sector is concerned and the general macros as well. With that, we'll slip into a break now. We'll get you more on the markets and a lot of stock-specific action. Stay tuned.